There's the recording.
Welcome, welcome. In about a minute, we'll get started. For those of you who have attended before, we always ask the stress-inducing question. Hopefully you can see the screen and hear me. And so maybe if you guys don't mind, if you just raise your hand if both of those things are working okay. So thank you. Thanks, John.
Great.
That's good. We're going to have a pretty big group today, which would be good. I'm sure based on Ryan's reputation, of course, and did a fantastic presentation at CGP on this topic more broadly too. Well, I'm going to go ahead and get started. So I am Brian Klontz, president of Charitable Solutions. A couple quick housekeeping notes. Many of you know we do not send out the slides directly. However, we do send out the full recording indirectly, which obviously includes the slides. I think we're up to 60 now. It's got to be really close. And we have a full YouTube channel with all 60, all free, all available, with a sort of a full table of contents there. So hopefully these are helpful to you and others. Ryan Raffin, my partner, is going to be taking us through the From Financier to Philanthropist, lots of F's there, alliteration, unlocking charitable gifts from private equity, venture capital, and hedge funds. And he has been doing a ton of that activity over the years, but in particular last year, which he'll touch on a little bit too. And then also note, we do not have the chat enabled, but we super encourage you to include any questions, comments in the Q&A. And you may remember we will scrape the Q&A from this session, do the same for Thursdays, and then when we send out the full recording next week, we will have that included as a Word doc, and that's also available sort of on the YouTube channel as well. So with that, we'll sort of jump in very quickly. I want to give Ryan tons of time today, but briefly sort of what we do. We are 2 days from now, we'll have our 23rd anniversary. So January 15th, 2003, I started the firm. And since day one, the mission was to and is to help make charitable gifts happen that otherwise wouldn't through risk management and aggregation, through structure and capacity. I'm not actually going to talk about any of these things on the right side. You can read those. You probably have seen these before. You can go on our website and see a list of that. On the left side, obviously, we're talking about non-cash asset risk management today. Again, not going to spend a lot of time here. We have cleared now the $6 billion of completed donations. Again, super importantly, we only work with charitable partners. We do not market to professional advisors or donors directly to expand their gift acceptance, capacity, speed, menu. And so with that, 100% of the gifts that we have worked on that have aggregated to that 6 billion plus were initially declined. 100% were initially declined by the referring charity. So just want to sort of call that out. The other thing is we're working on one right now, a very large one, direct DAF investment. So this continues to be very much a growing area for us where we have super successful either real estate or more typically private equity. So Ron will be talking about that today too. But private equity investors who are just annoyingly good and successful. Everything they seem to touch seems to win. And they say, if there's any way that we can have our own DAF investing in those types of illiquid or alt assets directly, that would be wonderful. And so that represents about roughly a third of our overall assets now are where donors are creating a cash balance in their DAF, and then they're making recommendations for us to do direct investments into many of the types of assets that Ryan's going to talk about today. So we did a lot of those toward the end of the year. And again, working on a very large one here, we think today we will see. So that's the non-cash side. The only other thing I wanted to call out was our National Gift Annuity Foundation. We did over one gift annuity every day last year. We're growing about 20 to 25%. We're in all 50 states, as you see there. We're up to 1,200 plus contracts. When we started with this 23 years ago, not a shocker, we were at zero. So 0 contracts in terms of the number of non-cash gifts we had done when we started, obviously it was 0. So we're getting just incredible momentum on both of those sides, but over 110 million in assets as well. And most importantly, the donors can make the gift annuity or create the gift annuity within the National Gift Annuity Foundation, and then be able to have 100% of the residuum paid back to the charity they were trying to give it to, or even multiple charities. So we've had a number of those where a donor will have multiple interests. Different charities might have different minimums, different assets otherwise they would accept. And again, most of these are cash and marketable securities. We just did our first crypto about 2 months ago for a gift annuity, do a lot in the real estate space. So I think roughly 15 to 20 real estate ones. And we're working on two right now that are retained life estates for gift annuities. So things that can be more complex there too. So that's really all I'll talk about here. We'll be jump to the next slide. These were our 2024 numbers. We were very proud of these numbers. The super theme here, again, this is 2024, not 2025. So we're still closing that out, as Ryan will mention. This does not, you can see, include any of the CGA or CRT activity. But all you need to know is for 2025, we will already know that we have doubled, literally doubled all of these numbers. So 100% growth in terms of total donations and the total value and amount too. So by far a record year. So I'll maybe just pass it over to you, Ryan, to sort of take us the rest of the way. Again, any questions you have, just put them in the Q&A, and I will answer as best as I go, or we'll call them out for Ryan sort of at the end or when appropriate. Okay, thanks, Ryan. Up to you.
Thanks, Brian. I just want to show off the AI-generated graphic that I have here. I'm very proud of myself. It's spelled correctly, a common problem with AI. So yeah, 2025 numbers not available at this time, but like Brian said, we saw a lot of activity in 2025, including significant growth in gifts of private stock and gifts with a private equity nexus. Did see something like 50-60% growth with things like real estate and cryptocurrency as well. So, really significant activity, but more details to come as we finalize our 2025 numbers. Quick agenda here. Basically, what I'm going to do is go over the terminology that you might encounter with these gifts of what I'll broadly call fund interests. So, what does that mean? What are the different flavors? What sorts of jargon might you hear? And then how do these different types of gifts work across the different types of fund investments? And then finally, look to the considerations for both charity that might be receiving a gift like this and what the donor might be thinking of more on the tax side. So just a really quick agenda there. And with that in mind, we'll just dive right into the terminology. One thing that I didn't say when I'd given a previous version of this talk, in the fall, but that I thought I should really call out this time as kind of a practical tip. I think it's really valuable if you're talking to a donor in this type of space that has this type of investment, that's considering this type of donation. Understanding the terminology and being able to use it is something that really builds trust and confidence with these donors. I've seen that personally. And just last week, I was talking to a university that said this exact same thing. They could tell right away that the donors were much more comfortable, much more confident when they knew that they were talking to a charity that understood these terms, understood what they meant. So I do think, if there's a practical tip I can give, understand the terminology, and that goes a really long way with these donors. That's probably true for most complex assets, but I think with these donors in particular, I've seen that time and time again. They really feel a lot better about the donation when they understand the charitable partner knows or has some comfort with this world and these terms. So what are these different funds that we're talking about here? Starting with private equity, a term that can be loosely used, and I'll talk about the different ways that people use that. What a private equity fund is the fund sponsor raises capital from outside investors to acquire existing businesses. Usually these are mature businesses, sometimes businesses that have existed for many decades, multi-generational family businesses often. And so the fund is acquiring one or more of these businesses with capital from their investors, and then hopefully at some point in the future, selling the business at a profit, returning the profits to its investors. Hedge funds, similar structure, and we'll see that with a lot of these. They have a kind of a similar structure, but the difference is the nature of the underlying investments. Hedge funds are very actively managed, heavily traded. They are investing in liquid assets, marketable securities, but they are also doing short sales. They're utilizing options and leverage and derivatives. So they are fundamentally looking at really a different asset to drive the investment and to return profits to their outside investors. They're looking at liquid assets. Carried interest and profits interest, again, something that has a lot of different names. You'll hear carry or promote or performance allocation. All of this is the same as carried interest. And what that is a fee paid to the fund managers for performance. And so basically you can think of it like a bonus. Where it's different from a bonus is from a tax standpoint. It is a long-term capital asset, and once it's been held for 3 years, it's classified as a long-term capital asset, and so it's taxed at long-term capital gains rates. That is something that comes up as a potential asset for donation in this space, this world of sort of fund gifts and investment funds. Rather often, donors will talk about donating their carry or their promote or their profits interest. And what about venture capital? Again, similar structure with a fund sponsor raising capital from outside investors, but they are instead investing in early stage startup businesses. And also, unlike private equity funds, I mentioned those private equity funds are typically taking controlling positions in the businesses they acquire. Venture capital doesn't do that quite as often. Usually with venture capital, they are taking smaller slices of these investments. So they are kind of fundamentally looking at businesses in a different stage, in a much earlier stage. So, more of the startup type investment. More terminology here, but these will be quick. Closed end, you might hear that used. All that means is that the fund has a defined lifespan, typically a 10-year lifespan with an option often for a 2-year extension. So a closed end fund is one that is going to exist for 10 years only. Usually that's what it means. Open-ended, they don't have a defined lifespan. Usually you'll run into that with hedge funds. Sometimes instead of open-ended, you'll hear the term evergreen, means the same thing. You will hear the terms LP and GP used a lot. That's just a reference to the fact that these are partnerships. And the LPs are the outside investors. They are limited partners. They have limited liability. That's a good thing. The general partner, that's the fund sponsor. It may not be literally the fund sponsor organization. Usually it's an LLC that they control, but the general partner is the fund sponsor. These gifts are almost always partnerships of various stripes, whether you are getting an interest in the GP or an LP. Sometimes you will see LLCs. It's the same tax treatment. These are partnerships almost always. And then finally, KYC and AML. That is not really specific to fund type gifts. You see it in the world of banking all the time. And Brian's talking about a gift that he's working on that we're going through some KYC and AML right now. Know your customer anti-money laundering regulations and procedures. These are compliance requirements. So if you hear KYC, AML, that just means compliance requirements that these funds have for investors and owners and partners. That's a quick overview of some terminology in this space. How do these gifts actually work? At a very high level, they look like any gift of private stock. The donor is making an assignment of the interest that they own over to charity. And then once that happens, at some point in the future, that interest is going to start paying out cash to the charity. Sounds good. We don't know when it's going to happen, but there will be hopefully some payout of cash. For that assignment, the donor gets a charitable income tax deduction, and the charity, of course, gets the money once the fund starts to pay out. So that sounds pretty simple. That sounds like any other kind of private stock gift. Is it that simple? Of course not. So the critical point, I think, with these gifts is understanding the structure and understanding the time frame and the nature of the investments. So what you'll want to ask when a donor approaches you about a gift of a fund interest, you'll want to ask, what are we actually receiving an interest in? Like what do you have that you can transfer to us? And how does that relate to the asset that has underlying value? This structure chart that I've got here is adapted from a real gift that happened. It's a simplified version. I think there was another layer entirely that had a bunch of debt and loans from banks because of the nature of the underlying investment there, which is the asset at the bottom. You'll see different types of assets down there. There's an operating company, or it's real estate, or in the case of hedge funds, it's a mix of ever-changing liquid assets. But this is often how these gifts look when you zoom out and take a look at the overall structure. And this gives us, I think, the first idea of where the complexity can come in, because there are a number of places where you can see the donation happen. In this case, I've got this yellow circle with the charity's interest. In that case, you can tell that that is a donation of carried interest by kind of the senior partner at the fund. However, I've got a couple other things highlighted. You could see a donation of the limited partnership interest in the bottom right. So the outside investors could give their LP units, their investments to charity. That's a long-term capital asset, same as any other. Or alternatively, the junior partners in the general partnership, that is, junior partners who work for the fund sponsor, could give their carried interest, and that's kind of over on the left side there. So there are a lot of different ways you could see the charity receiving an interest here. And that ties into how the term private equity can be kind of loosely used. We get these all the time. We get an inquiry from a charity that says, we've been approached about a gift of private equity. Can Charitable Solutions help us? And then I usually have to respond and say, okay, well, what do we really mean here? Because private equity can just mean non-publicly traded stock, right? It's not public, it's private, it's equity, it's ownership in a business. Okay, but publicly traded stock doesn't necessarily mean that there's sort of a private equity nexus in the sense that we're talking about today, where there's private equity funds. Sometimes uh, sometimes the private company stock has private equity ownership already, and that's what the charity means and the donor means. Oh, I have stock in a company that I founded that private equity acquired 60% of, but I still own 40%. Okay, well that's a private stock gift. It does have that private equity nexus. Sometimes they mean that the company is about to be acquired by private equity. Again, a private company stock gift, not really a gift of private equity fund interest itself. Now, but they might mean, oh, this is an LP interest in a private equity fund. This is someone who invested in the private equity fund, now wants to give an interest in that fund. Now we're talking about an actual interest in the fund itself, not a private stock donation. And then, as I mentioned on the prior slide, we could see a donation of a carry or profits interest. That means you're getting a donation from someone who actually works for the fund sponsor. Those are the only people who get carried interest that they can give away. So these gifts, when we hear just, oh, it's a private equity donation, you really need to drill down and understand, again, what does the donor mean? What are they trying to give away? And what's the overall structure here? If I could give another tip, just ask the donor, is there a structure chart like this? Can you circle what you want to donate? And can you circle where the actual underlying value is that's going to generate cash? That's really helpful to kind of situate yourself and understand what the donor is trying to do, what they're trying to give away. One thing that is super common, almost a requirement with these types of fund gifts, especially in the private equity space, is that senior leadership is going to need to approve the donation. You will never ever see a partnership agreement for a private equity fund that allows the limited partners to freely transfer their interests without sign off from the fund sponsor, meaning the general partner. Similarly, you see those same restrictions with carried interest. The junior partners are not going to be able to donate their carry to charity without the senior partners signing off. I have had perfectly qualified gifts of carried interest from junior partners die on the vine because they said, "Oh, we talked to the founders of the fund. They won't approve the donation." Really, disappointing result because the donor was motivated. It was a good gift. We were ready to accept, but senior leadership wouldn't sign off on it. You can't get the gift done in that case. And that is a common feature with these private equity donations. I mean, we did dozens of them last year. Every single one, you need that sign off from senior leadership at the fund. Another thing with private equity donations that you'll want to understand, based on the nature of the underlying investments that the fund has, is this going to be a long-term donation? Is this going to be something where it's held by the charity for several years, maybe with payouts the whole time, but still held for several years? Or is it something that is going to have a fairly discrete short-term time frame? Sometimes these private equity funds have a single company that they have invested in that will be sold in the near future, and that's going to generate cash in the near future for the LPs, for the fund sponsor, and they're going to get their carry. Uh, that type of situation, the one and done situation, is probably the ideal. If you had to pick, that's probably the fact pattern you want. But they can all work and they can all work very well. But again, you want to understand, okay, is it one portfolio company? Is it a dozen? And knowing kind of what you're getting yourself into. Because if it's a dozen companies, it is going to be a long-term hold. You can be certain that it is going to be years that you'll be holding the position. Hedge funds, on the other hand, are a little bit better in terms of time frame. They're a little bit simpler in some ways. The paperwork tends to be, I've got here on the slide, off the rack in the sense that they have a big stack of forms that there is zero flexibility on and needs to be completed, but that paperwork is ready to go and will be handled usually by a fund administrator. That's often a third party that is affiliated with a financial services firm. So that's good in the sense that this paperwork typically even contemplates a 501c3 owner. So it's a little bit more, order off the menu than a private equity fund gift is. Uh, so that's good, and the time frame is actually a little bit more certain as well because these funds will typically allow for transfer on a regular basis, often quarterly. When they say, at quarter end, all the transfers get processed. We need notice 45 days ahead of time. And so you can work with your donor to make a donation happen within the requirements of the fund, knowing what those timeframes are. And then better still, they allow for redemption, a quarter later. Usually the transfer and redemption windows are on that kind of quarterly or at least annual basis. And you can find that out upfront and know with certainty going in, when is the donation going to happen? When is the redemption going to happen? Because these funds are open-ended, they exist for a long time, they are actively traded, that generates liquidity, and that liquidity allows for this redemption to happen basically at will, subject to those timeframes that the hedge fund sets. So that's something where you can understand that going in. You can know really even likely about how much cash the redemption is going to generate for your charity, because your donor will be getting capital account statements that say at the prior quarter end, what was the investment worth? That'll change from quarter to quarter, of course, but there's a little bit more certainty, a little bit more simplicity here with hedge funds. And you can see a donation of carrier management fees with hedge funds as well. Not as common, but it is possible. Finally, venture capital. Venture capital, because they are investing in startup stage companies, you are going to expect a long lifespan with these types of fund interests. One thing that we've seen is, capital commitments are going to be a common requirement. Investors will have to pay into the fund so it can go out and make these seed stage or early stage investments into these startups. You can see a lot of growth. That's one of the appeals with venture capital. But those capital commitments, that's something you're going to want to discuss with the donor really as early as you can, and understand, okay, it's $1 million position, but you've only paid in $500,000. What's going to happen with this remaining $500,000 that's due? And you may want to talk to your donor and say, can we get a cash contribution to pre-fund this with the fund? We'll pay them now. It'll be fully paid up, and there won't be a scramble to give them, $75,000, because they will email you. I promise this. They will email all of the LPs out of the blue and say, by the way, we need $75,000 in the next week. And if you're an LP, you've signed the LP agreement, you've agreed to pay those amounts. So you need to come up with the money. With venture capital, I think you want to talk to your donor, understand what the capital commitment situation is, and make plans to pay those capital commitments ideally ahead of time. And then I did want to mention real estate development as well. Those structures can look very, very similar to this. And in fact, the structure chart that I used a few slides ago, that was actually from a real estate development structure, a real estate development gift, quite a large gift. But oftentimes, when you get those inquiries, it's not coming in being presented as a gift of a hedge fund or an LP interest. The donors say, "Oh, it's a gift with real estate," and you say, "Okay, is it a vacation condo? Is it an LLC that holds an investment property?" No, with these donors, it's typically a more complicated structure, like the ones we're talking about here. They do get carried interest, most often called promote, for real estate developers, but it is still a carried interest. One thing that does distinguish it from the other fund interests and fund gifts is the presence of debt. That's much more common with real estate development. Usually, they will, in addition to getting cash from outside investors, they will utilize leverage to acquire a very valuable property. They will fill that property up with one or more strong tenants, long-term leases, and hopefully, pay off that debt over time. There's often refinancing. This makes the analysis very, very complicated with real estate development funds and structures, because with debt, we're talking about bargain sales for the donors and UBTI, unrelated business taxable income, for the receiving charity. Not to say that these gifts can't work. They can work very well. But the structure is complicated, just like it is with private equity, hedge fund, venture capital structures. And you layer in the fact that there is debt very often with these types of gifts. So these can be in the mix as well, similar structures. I'm just going to pause and look at the questions here. Let's see. So one question, if someone's donating private equity that has 6 years left in the lifespan, does the organization add the private equity to their portfolio, or do we just anticipate a payout and the donor keeps ownership of the private equity? That depends, I think, a little bit on whether the donor needs the deduction in the current year or not. Because if there's 6 years left, the payouts will probably begin in the next couple of years. And so I think the question for the donor is, is your income high enough this year, and is the fair market value of this interest high enough that it's going to be worth donating in the current year, even though payouts may be a few years away potentially. Uh, that's something where these private equity donors can sometimes get a little bit ahead of themselves, and they want to do the donation now, even though from a tax standpoint it might not make sense. The fund may not have enough value now versus in the future when it's about to start payouts, the value is very high, comparatively speaking, and so they get more tax efficiency by donating when the fund is more mature. Um, so that's up to the donor, but I think it's a question where the donor will need to do an analysis with their CPA. Let's see. A couple other questions here. Yeah, KYC. One question to the point that KYC can be challenging. Yes, I agree, and have we'll talk about that a little bit more. And then another that the closed-end funds nearing maturity, the fund being very tax inefficient. Yeah, and those are not always ideal for the charity either, in our experience. They can be kind of more trouble than they're worth in terms of what it takes to onboard the gift and redeem it out. And I think it's really a question of understanding how much value is left in the fund. Let's see what else. Yeah, these questions are coming in fast. Um, yeah, well, I'll talk a little bit about REITs in well, actually, no, I think yeah, REITs might be good to talk about now. REITs, a lot with a REIT depends on the structure of the REIT, as with other types of fund gift. And REITs are really a bit of a different animal. But like these funds, they do have pretty regular reporting that will give value. Um, the issue with REITs, and this is true with real estate developments, like I just talked about, is they often have a lot of debt, and the debt can be a total deal killer from a tax standpoint. Um, So understanding the structure of the REIT, if it is a REIT that is generating a K1 for owners, then debt is something that you are much more concerned about from a bargain sale standpoint. Uh, if if it's getting instead of 1099, that tends to look a lot better. You're not worried about a bargain sale. You're not worried about any UBTI from a donor standpoint. Um, so a REIT, REIT can work in certain circumstances, but it is a bit of a different animal than these fund type gifts that we're talking about. Um, let's see what else. Appreciate all the questions here. Are publicly traded REITs the way to go? Yeah, if you have the ability to choose, yeah, I would go with the publicly traded REIT for sure. Um, but you do want to be careful and make sure that it's not an UPREIT structure where you can get private units that can be exchanged for public REIT units. Because the units that are being donated are private, then you're kind of back into the tax complexity where the debt can really sour the whole gift, let's say. Okay, so I think I've probably paused long enough to answer the questions there. Appreciate all the questions coming in here. So, from the charity standpoint, we've talked about the structure, but let's talk about the dollars. The charity is wondering what, and the charity needs to understand what is going to trigger payouts. What needs to happen with this fund, with this interest, whatever it looks like, to trigger payouts. Is that going to be a redemption, like with a hedge fund? Is it going to be a sale of an underlying asset? Okay, if so, how does that happen? And then critically, when does that happen? What does the timing of these payouts look like? Because with with a gift of this sort, you're likely to see payouts on a quarterly basis for tax purposes. All of the other owners are not tax exempt, or nearly all are not going to be tax exempt. And so they're paying taxes, quarterly estimated payments. So there will be usually quarterly payouts that are small. So there's going to be ongoing payouts in most cases, but there are going to be hopefully big payouts when the portfolio investments get sold. When does that happen? And what needs to happen to trigger that? So understanding for the charity what is going to happen to generate cash after this gift is complete, you'll want to understand that before you decide to accept, because it may be many, many years out. It may be something where actually it's unlikely to see, any real payment or serious payment. It may be a private equity fund that only has, a couple years left. It's already paid out nearly everything. It might not have that much value left. It might not, that means it may not be worth accepting for your charity. And then the other thing with these types of gifts is, unfortunately, these are not gifts that are a one-way street in terms of the movement of money. These can be gifts where charity needs to pay for holding the position. And that does include the capital commitments that we talked about with venture capital. You can see that with private equity as well. In theory, you could see it with real estate development. So understanding capital contribution requirements, that's something you'll need to understand. Certainly unrelated business taxable income, that's going to be in play for a lot of these types of structures, particularly if there's debt in the mix. Hedge funds will often have UBTI, very, very often, real estate development structures, but private equity can as well. If they're using leverage, you're likely to see some UBTI. So you'll want to understand that. And you could even have a case where the fund claws back money that's been received. The fund sends out distributions and then realizes, oh, we sent out too much for whatever reason. They're going to have a right to claw that money back. So that's something that the charity will want to understand before accepting, and will want to have a conversation with the donor of, okay, in the event that we need to pay money back to the fund, or we need to pay money to the IRS because there are taxes due, how are we going to handle that? So certainly you need to understand that. Tax and legal considerations, as I've emphasized, I think understanding how long this asset is likely to be on your books is critical, and not just in terms of the cash flow, but also in terms of the tax reporting and audit reporting that you, the charity, are going to have to do by carrying the interest. If it's a gift that is going to be held for 5, 6, 10 years, you need to know, and your accountants need to know, that you're going to be getting a K1 for many years to come. And potentially, as it says in the next slide, there could be taxable income for many years to come because of the holding of this long-term position. One good thing with these types of donations is that these funds, and often these donors, will understand what UBTI is. This is not like a donation of private stock that's taxed as an S corp, where the donor has just built the business and they don't really have a strong understanding of the tax implications. They probably don't know what UBTI is when you're talking to an S corp donor. When it is a private equity or hedge fund or real estate development donor, or maybe just the fund itself, they know what UBTI is. So as you, the charity, evaluate the gift, you want to have a discussion with them about whether UBTI is likely. And that's where you might even have a conversation about, okay, are there other tax exempt owners? If so, is there something called a blocker corp in play? And that's a kind of an intermediary corporation that cleanses the UBTI for exempt org investors. So that's worth asking about, because you will see that from time to time, particularly with hedge funds. Sometimes hedge funds will have entire parallel structures for exempt org investors. This next point I think is can be easy to overlook, which is understanding the portfolio investments, not just from a liquidity standpoint, but from a reputational standpoint, because the portfolio investments may be something that your organization is not comfortable with, and which would trigger perhaps uncomfortable questions from your board and other donors. For example, we did one years ago where the private equity firm had acquired a company that produced vapes, so nicotine product. I'm sure there are people watching this who would say automatically, regardless of how good the gift looked otherwise, because of the nature of the investment, because it was nicotine related, that's out. And that's totally fine, but I think you need to be sensitive to that and to understand what kind of investments are these really from a reputational standpoint? Is it something that's going to raise some risk in that regard? Uh, Also, another thing that will come up and will really complicate things for you from a tax and legal standpoint is if these funds are offshore. Um, that can make that can make these gifts a lot more challenging. Um, if it is an offshore fund, we are talking about a foreign jurisdiction with its own laws. We have potentially significantly more tax complexity if we are looking at what's called PFIC or CFC status. That's passive foreign investment company. For PFIC and CFC is controlled foreign corp. Those can introduce significant tax reporting obligations and UBTI. And offshore interests, they especially if this is a European private equity fund, which we've run into a couple times, they have really, really significant onboarding processes that are much more time intensive and much more work than domestic private equity funds, which goes to the final bullet point, the KYC, the AML. European know your customer and anti-money laundering requirements are much more intensive than domestic ones. In any case, KYC and AML, that's something where you and the donor might be totally aligned on the gift. The fund might be signed off. You're ready to go. You get a big stack of paperwork, and at the end are a bunch of questionnaires that need to be filled out by the charity, explaining who the charity is. Is it an accredited investor? Is it a qualified purchaser? These are all compliance questions that will need to be answered. And the part that is really time intensive for the charity is when they start asking not just about the charity itself, but the management, the individual management, and individual board members of the charity. This KYC and AML will often require copies of IDs, social security numbers, proof of address for the management and board members of the charity. That can really take a lot of time to put together. That can really be a pain. I know I hate asking Decamai's board to provide copies of their IDs and proof of address. And we have a fairly small board. We're talking about 5 board members. If you have a large board, that is even more work. That can be really, really tough at year end. If it's December and you're trying to get one of these gifts done, and it's a gift that you've decided is worth doing, but you need to track down copies of IDs from your entire leadership team and your board, that can really throw a wrench into things. So that is something that is easy to overlook, but really, really can take a lot of time and can require a big team effort. I'm going to pause here and pull up some more questions. Oh, yeah, some interesting questions here about blockers. Yeah, Don points out blocker corp structure does not necessarily work for charities. Yeah, Don, I would tend to agree that the blocker corp, it can work depending on the structure of your own charity. I think it probably, with a corporate form charity, a blocker looks pretty good. If your charity is in trust form, which Decamai has, and I know Chicago Community Trust has as well, where the Don, who asked the question, is working. I don't think a blocker is a net benefit in that case. Um, Another question, and this is an interesting question. If the charity generates operating losses, does that help to offset the UBTI? Um, it- I think it depends on the siloing rules. I think it depends whether your income from the UBTI source, private equity fund, hedge fund, real estate development fund, is siloed, so that's effectively isolated for tax purposes. In that case, I think probably not. But that would definitely be a question for a CPA. So yeah, interesting question there. Let's see. And Brian's answered a lot of these.
And
Just
importantly, I had the same answers, thank God. So,
yeah, that's good. Oh, yeah, and Don had another good question about reporting at the state level. Yeah, and your answer there, Brian, I think is worth mentioning live so everyone hears it. If you are getting a federal K-1, you are likely almost certainly going to receive at least one state K-1 equivalent, and oftentimes many, many more. And so your tax team, as you consider this fund interest, will need to understand it's not just going to be the federal K-1, but also state equivalents. And that may mean filing in a bunch of states that you have never previously filed in. And that could be a lot more work. State returns are usually not as complicated, but we're talking about multiple state returns in all likelihood. I think it's unlikely that you would only get a single state. Not impossible, but unlikely. Uh, so, you know, these these gifts, when those K1s start coming in, it's easy to overlook the K1 because it comes in long after the gift has been accepted. You just closed out 2025. 2025 K1s are not going to come in until March, probably at the soonest, and more likely it's going to be August or September. So you think, oh, okay, well, we'll worry about that then. And then you see a K1 that's 80 pages long when it comes in. And 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 that's something that you need to report on and potentially file a tax return for in a bunch of different states that you may not be otherwise operating in. So the state call out is a good one for sure.
and
Um,
one point I'd make there too, Ryan correctly said, many of the state returns are not overly complex. If any of you have had the joy of doing that, getting in many cases they require, the same information that's on your, 990T as an example. Some of that is easy to sort of pull over or import, export, and some of that is not. And then the other issue is that different states have very different interplays between, especially relative to UBIT, any kind of charitable deduction at the state level. So some have, they're not consistent at all, as you would expect with 50 different states. So sometimes it's less about the filing of the return. The other component is like, what does that mean from a net UBIT standpoint and that calculation? Because we've got a person, I don't know how she does it, but that's all she does for us. Like that's all she does is UBIT K1s and state filings. And every year we have to go back and figure out, okay, have any of the states changed any of their income tax returns? Yes or no? Have any of them changed anything relative to the charitable deduction against that state source income? So it's one state okay, two states okay, and then you can see incrementally just kind of get worse and worse as you go.
Absolutely. And yeah, that the state filings are they will quickly become a headache. Hopefully not insurmountable, and hopefully they don't make the gift more trouble than it's worth, but they can really pile up, as Brian said. But from a tax and legal standpoint, that's kind of what you're looking at. The tax reporting, federal and state, the UBTI, and you can flesh that out with the donor. Certainly reputational risk, if that's in play at all, you'll know that early. KYC and the AML, that's going to be part of the onboarding process. You don't want that to be a surprise, but you should get that taken care of ahead of time before the gift is complete. Um, and then once the gift is complete, you're really thinking about sort of the ongoing reporting from a tax standpoint. And then you'll normally receive capital account statements from the fund on a quarterly basis, which give you an idea of how much the investment is worth. That's good for audit purposes, for reporting to your board. You're carrying this complicated fund gift. What is it actually worth? Well, you should have current reporting for that, thankfully. So ongoing reporting, that does take some time, and that is on this next slide here. One of the downsides. The upfront due diligence and onboarding that we talked about. That's a cost on the front end for staff time, but the ongoing reporting, that depending on how long you're going to hold this fund, how long you're going to carry it on your books, uh, that is something where you may be signing up for kind of years of work. Hopefully receiving years worth of income. And that's the other thing is, you want to understand, is it going to be 5 years before we see a dime from this donation? But that ongoing reporting can be a pretty significant downside. It's easy to overlook on the front end because you're in the gift planning. You're thinking, can we get this done? What is it going to be worth? Without thinking about, okay, what does the care and feeding look like after the gift is done? And then, of course, the out-of-pocket costs, like I talked about a few slides ago. Unrelated business taxable income typically is the big one. Capital calls, that's another one that is very common. The out-of-pocket costs, that's you, the charity, paying to the IRS or to a state agency. Capital calls, that's a payment back to the fund itself. So the capital calls, those are something you'll need to understand on the front end. And certainly have a conversation with the donor of, okay, this outstanding unpaid amount will become due. What are we going to do to pay it? Because you, the charity, probably do not want to cover that yourselves. So you want to have a conversation with the donor about how they can help you cover that expense. On the donor side, just a couple slides left here, so I think we're going to be finishing right on time. And this is something that does help charities out a lot. So many times I've been thankful for this. These are complicated gifts, but these are sophisticated donors, and they have strong teams of advisors almost always. So that really helps. These donors often know what UBTI is. They typically have a background in finance, or a legal background, or both. They really understand the structure they're dealing with. They understand how to make the gift. And if they don't, they usually have hired the right people, tax, legal, financial advisors who can help them navigate the gift. And that will help you as the charity as you're having these conversations in the early stages, fleshing out the gift, understanding the structure, understanding the timeline, knowing that the donor and the donor's team can fill in the gaps, and that the donor is not going to get, hopefully, bad advice from someone on their team. As with other asset types where debt is in play, we can see bargain sales here, particularly with real estate developers, also with hedge funds and sometimes private equity. So bargain sale, that can apply, and that can be a deal killer if we're talking about a really significant amount of leverage. If the asset has a lot of debt, whether it's recourse or non-recourse, that may create a bargain sale that means the donation is not worth doing for the donor. Um, Also worth keeping in mind, none of this means that the normal qualified appraisal and 8283 process goes away. All of that's still in play. Donors are still going to need to get a qualified appraisal. And those can be tricky if we're talking about a fund that's in the very early stages, like a venture capital fund, where these are early stage portfolio companies, maybe don't have a huge value and they're tough to value. So qualified appraisal can be tricky in some cases like that. The other thing that does come up from time to time with these types of gifts, assignment of income. Those rules still can come into play as well. If it is a private equity fund or a real estate development fund where the timeline is actually very short, there's going to be a sale of a major portfolio asset in the near term. You may have an assignment of income problem, and that's something that can, one, cause the donor not to proceed, or two, if they do want to proceed, you, the charity, may need to move very, very quickly to get the gift done in short order before the assignment of income becomes a real issue for the donor. So assignment of income can still come up, even though we're not talking about maybe your classic assignment of income fact pattern, which is usually sort of that private stock donation ahead of the sale of the business. That's sort of your classic assignment of income fact pattern. You can still have that kind of a couple steps removed with this fund interest because ultimately these funds need to sell their portfolio assets to generate profits for their investors. That's where you, the charity, are going to get your money. So, assignment of income may still be in play. And then the carried interest loophole, that's probably worth mentioning and spending a minute or two on here. This is a constant target for reform. In 2017, the tax treatment changed a little bit. The carried interest prior to 2017, I believe, got long-term capital gain treatment after 12 months, like any other capital asset. In 2017, that changed to a 3-year holding period. And then last year, in 2025, I thought potentially they would do away with that long-term capital gain treatment entirely. I think you can find a webinar from about this time last year where I make that prediction, which was wrong. It was not touched in the current round of tax reform. But it's worth noting that if it did get changed from the carried interest being taxed at long-term capital gain rates to ordinary income, that would actually make the donation look even better because we're talking about, from a tax efficiency standpoint, an asset that is taxed at a much higher rate. Moving that to an exempt org owner uh, really gives the donor much better bang for the buck, assuming, and this is the big assumption, that if there was reform, that these interests were still treated as capital assets. If these carried interest payouts just got treated as true bonuses, that's going to be ordinary income and compensation that is probably going to be tricky to donate. So carried interest reform could take away a big slice of the pool of fund interests for donation if there was serious carried interest reform. But it could also make it better if we did see that shift from long-term capital gain treatment to ordinary income. Then we could see these donations really take off and they might look a lot better. So I think we've got a few minutes left for any final questions. And then just to really hopefully tie a bow on this, um, items to understand: structure, timeline. What are you looking at for the gift, and what are you looking at for payout stream? And understanding the terminology. I don't have a background in finance or banking. I learned everything in this from working on these gifts over the last several years. So if I can do it, you can too. I'm not anything special. I don't have any real background in these types of funds. So learning the terminology is totally doable, even though if you're coming in blind, it can seem like a lot of jargon. So take a look at these last couple questions. And yeah.
Yeah, one from Don, which is a good question about what if it's anything other than the straight liquidation of cash
Hmm.
uh, as settlement proceeds.
Yeah, that's so Decami, we have been in that situation before. Most often, what you are getting in those cases is public stock, thankfully. Um, Not always the case. There are cryptocurrency venture funds out there that will simply send their investors cryptocurrency, not cash. So you have to be open to that possibility, I think. And the problem is that usually the donors don't know exactly what form the consideration is going to come in, and they say, "Oh yeah, probably cash, but it could be crypto, could be a note, could be public stock, who knows?" And so that's something that you're probably not going to have a solid answer on unless there is some real near-term liquidity. It's worth talking to the donor, taking their temperature, but you probably won't know for sure. We're open to basically whatever form the consideration comes in, but if we had our druthers, yeah, cash is king.
Right. And some of these too, obviously, if you're an LP, especially a smaller one, you're not going to have really any visibility whatsoever in terms of what the GP is negotiating. And then we had one situation where like, oh, it's public stocks. We're like, oh, that's great. And like, oh, but it's on the Australian exchange. Like, okay, that's different. So even when you hear public stock, don't necessarily think that's a slam dunk. And or it's a rollover to a private Nuco or something like that, or as Ryan said, a note. The main thing, and I think this is really important because we almost got smoked on it about a year and a half ago. The main thing is that the charity has to be treated in exactly the same way as all the other shareholders, period. And so there are some donors, hopefully the minority, that would say, "Oh, charity just wants cash. We're going to take, all of this other stuff that might be worth more." Or the reverse, they might say, well, I want the cash. Charity ought to be happy for whatever they get. We're just going to basically take the low hanging good fruit and give them fruit that may even have equivalent value, but that may not be similar to the options given to similarly um, placed shareholders, or members. So the key is we just have to be treated in the same way. Maybe, Ryan, if you just want to go one more slide, I think we're dead on
Sure.
time. We're going to go ahead and wrap up. Fantastic job on a very complex area. He has definitely learned the terminology to be sure, but it's been, I think, over almost 10 years of dealing with, I mean, like seriously, like two or three of these a week. It's got to be, at least in terms of perspective conversations. They may not all go forward, but it does take a lot of reps in this space because there's so many different flavors to the issue. So again, more than 60 of these. I already posted the link in the Q&A. But hopefully, again, these types of webinars are helpful. Hope everybody had a good time, and anything else we can do, definitely let us know. Again, this will come out with the Q&A scraped next week. So everybody have a great day. Ryan, great job.
Thank you all.